Hey guys, Tim Melvin coming to you from down here in Central Florida. It's kind of an overcast morning. We've had a rain front that's just kind of moving on through, dumped a little rain on us. Made me kind of wish I was out in Arizona at the Acquire or Be Acquired conference. I skipped it this year. Just way too much going on, too much travel in December and January with Christmas and a new grandbaby and some business travel relating to a new project my son-in-law and I are working on that hopefully you'll be hearing more about sooner rather than later, but we've had the usual time frustrations with that deal. Anyway, so it's supposed to clear back up, get back up into nice 70s and sunnies, maybe a little bit less than that tomorrow. But, again, after being cold in Chicago and Baltimore and a few other places over the last couple of months, reminded why I like living in Florida so much. Now, I'm not out in Phoenix at the Acquire or Be Acquired Bank Conference put on by bankdirector.com. But I do have some spies on the floor, and well, to be honest, my good friend Al Dominic, who's the head of Bank Director, has done a fantastic job of tweeting out articles for the first day of the conference. He'll do more again today. If you're not following Al, if you're interested in bank stocks, you should definitely be following Al Dominic and the other folks at Bank Director. There's plenty of information and discussion about what's going on at the conference. Some of the things that Al hit in his most recent post are areas of interest to us as bank stock investors. First off, there's been a lot of talk about regulatory trends. Are they going to raise that, rather arbitrary $10 billion Durbin threshold? More importantly, will they raise the $50 billion systemically important financial institution limits outlined in Dodd-Frank up to $250 billion? That brings a whole bunch of folks back into the bank takeover business and could really spur M&A in 2018, particularly among, say, the 10 billion and up banks. Now, we don't own too many of those, but again, that's going to put tremendous pressure on those below $1 billion in assets to either grow, combine, or sell the institution, because you're just not going to be able to keep up as other banks gain dramatic scale and improve their efficiency ratios, lowering their costs, and they're just going to be able to outwork you at that point. So that'll put a lot of pressure on our smaller banks to go ahead and grow or merge. We're okay with either one of those because either one ends up in a higher stock price for us. Another trend, and I've talked about this pretty much every year, when you go to this conference and you look around, and I've met a lot of great folks, made some friends out there, but as you look around, this is a very mature, white male crowd. Banking is not a super sexy industry anymore. At one point, it was considered an excellent career path, but with everything going on in technology, in investment banking, and in just so many other fields that are so much more attractive and potentially lucrative than banking, banking has had a hard time attracting the top tier talent, particularly at the community bank level. Excuse me, don't know where that came from. So they're not able to offer the compensation and in a lot of cases the upside to attract the bright young talent coming out of business school. So succession is an issue. And the average CEO is over 60, the average board member is 66. These folks are getting old, and you've either got to have a succession plan, which again, with a little bit of a talent dearth, that's been hard to do, or your succession plan has to include an exit strategy that cashes you out of the bank. Again, another driver of additional bank M&A going forward. So, technology. I've started talking about this almost 3 years ago, where it wasn't just regulatory costs that were going to be a huge problem for smaller banks. It's technology. And the banks with the better technology, particularly on the mobile banking side, are winning the deposit war. And that means the bigger banks are winning both. So the smaller banks, they're looking at the technology costs. It's going to be very hard for them to keep up with the bigger banks. So again, that's another driver of bank merger and acquisition activity. So all of the drivers of bank M&A are still very much in place with us. We don't really have too many concerns as we look at banking. Indeed, as earnings have come in over the past couple of weeks, the chatter, and it's at the conference and it's been in earnings reports, everybody's pretty excited about the long-term implications of tax reform. It's really providing a huge boost to the bottom line of smaller community banks, and even the larger regionals are also seeing a bump. We're seeing this money being spent, some of it on dividends and buybacks, which I'm not real thrilled about, particularly with the bigger banks. Rewarding shareholders is great, but you also have a workforce. You have some needs to spend on capital projects. But we are fortunately seeing a lot of that. A lot of raises, a lot of increased minimum wages, a lot of one-time employee bonuses as a result of tax reform. So that money eventually finds its way into the economy and is good for everybody, and not just those of us in what I call the shareholder class. So um, the earnings coming in, they're great. Most people are taking a one-time hit to earnings and to book value. Between 1% and 6% seems to be, with 6% kind of the max and pretty rare hit to book value. But long term, again, that's just a huge bump to the bottom line of most of these banks. So everybody's pretty enthusiastic, seeing solid revenue growth, decent deposit growth, book value growth, well, book value write downs, but because of the tax hit. But yeah, reasonably stable. Everything's pretty good. Nothing to worry about at all on the credit side. Consumer credit looks fantastic. Not really seeing any upticks in the leading trouble indicators, which are auto and student loans. Residential mortgage is just in fantastic shape. Same on the commercial credit side, just not really anything to worry about. We're waiting for bankers to do something stupid. I'm watching for bankers to do something stupid. I expect them to eventually do something stupid, but so far, so good on the bank earnings side. Now, I was reading around. I do a lot of reading, as you know. I'm going to talk a little bit more about that in a minute. But I came across on Toby Carlisle's Acquirers Multiple site, which I read all the time. I'm a subscriber to Toby's service. I think it's fantastic. But I read his blog religiously. And a story on there yesterday about Munger and Buffett repositioning Wesco Financial back in the 1980s away from just being a thrift and into more of a broader financial services, and as it ended up, an investment company. Most of the money there was bought by stuff that they invested in. So I want to make sure I get this story right. So I pulled it up on my phone here and promptly lost it. Here we go. They One of the things they did was in 1988 they bought 28.8 million shares of Freddie Mac for $72 million. And they did this again as a way of diversifying away from being just in the thrift business. Now, 1988, if you think back to 1988, the crash of 87 was over, but we were starting to see signs of the cracks in the S&L industry. So, banking stocks were out of favor, and they were cheap, as you can see by the price of Freddie Mac here. 10 years later, or 11, let's call it, at the end of 1999, that $72 million was now worth $1.38 billion. Now, this is the part I wanted to make sure I got right, because Munger talked about this at one point in time, and here's what he said. Our experience in shifting from savings and loans operation to ownership of Freddie Mac shares tends to confirm a long-held notion that being prepared on a few occasions in a lifetime to act promptly and scale in doing something simple and logical will often dramatically improve the financial results of that lifetime. A few major opportunities, clearly recognizable as such, will usually come to one who continuously searches and waits with a curious mind, loving diagnosis involving multiple variables, and then all that is required is a willingness to bet heavily when the odds are extremely favorable, using resources available as a result of prudence and patience in the past. Now, two things. First off, that perfectly describes what we've done with banking on profits over the last few years. This is a multiple decade opportunity. It's not going away anytime soon. It won't be straight line. It will respond to market forces. We may be coming into the later innings of this particular round of this very long-term trend. Valuations are starting to show some signs of that. But we recognized the trend. We were able to divert resources to it that we had saved up, because remember, we got out of banks late 2006, 2007. We're kind of hoarding cash a little bit because, frankly, we found the world to be kind of a scary place. So, banking on profits is certainly a great example of acting in the manner that Munger behaved. But now let's apply this extraordinary opportunity idea, to the broader market. Step back, take a look at the world, and ask yourself, is this, after almost 9 years of a bull market, with prices averaging about 18.5% since the bottom back in March of 2009. And the market trading at 26, 27 times trailing earnings. Does that look like a spectacular opportunity to you? It doesn't so much to me. And while I'm not making a prediction, because the one thing I've learned over the years is I'm horrible at predictions, but I will say, as the market's gone up, our sense of caution has increased. Last year, for the first time, we put a hedge in place. We renewed that hedge this year. We have about 30% cash in the portfolio, and we're not in any big hurry to spend it. We're having a hard time finding stocks, bank stocks included, that trade at our multiples and have all the conditions and balance sheet strength that we like to see before entering a trade. We're not rushing to sell anything. The cash is a result of takeover activity. I think we've only pulled the trigger on one that had just simply appreciated to what I thought was an unreasonable level. Everything else has just been, a result of takeover activity and not being willing to take new stock in the deal. So that cash level is going to continue to creep up as we continue to get takeover activity in 2018. And right now, we're just going to be cautious. We're going to be careful. If we can find it, we'll buy it. If we can't find it, we're going to sit here and wait for an extraordinary opportunity. Prices have been flying up since tax reform. In January, the market is now up about 7.5%. That's the best since, wait for it, 1987. So let's just kind of be careful out there, guys. Okay, Ray Dalio in Davos kind of outlining, he's much better at prediction and timing stuff than I am. He kind of outlined what he saw going on out there. He said, we're in a melt-up, and tax reform is going to continue to drive that. The economy's getting better. Markets are going to move to new highs. You're going to feel pretty stupid for holding cash because asset prices are going to go higher. But he cautioned that type of economic growth, maybe we could get to 4%, some folks at Davos, as far as the U.S. GDP growth rate. That's going to cause the Fed to move too soon, too fast in raising interest rates. That could be a huge problem and lead to what Mr. Dalio called a meltdown. So we could have a melt up lasting even 12, 18 months. But the meltdown following that could be quite dramatic. So, and of course, our timing could be completely off, and that meltdown could come sooner than expected. So we do need to be a little cautious where asset prices are concerned. Okay, now moving along. Talked a little bit last time we did a video about the new reading approach. I decided I wasn't reading enough non-market related nonfiction, biographies, that type of thing. So I put a new rule in place. Before I can do my recreational reading every day, and of course I do a ton of it. If you follow me on Goodreads, that's kind of obvious. I read a book every day or so, sometimes a little quicker if there's not much going on around the house. So every day I have to read a certain percentage, and I've been just kind of deciding based on the book of a nonfiction book. And I've leaned heavily towards biographies, but I did reread Anti-Fragile by Taleb in preparation for next month's release of Skin in the Game, a book I'm really looking forward to. But we've read biographies on Eisenhower. We did Chernow's Grant back in December, which is just a fantastic book. Highly recommended. We read Charlie Kreutzmann, the drummer of the Grateful Dead. Read his biography and talk about his years on the road with the band because I am kind of a Grateful Dead fan. We did Eisenhower, Grant, Kreutzmann. Now we're starting Philip Tetlock's Super Forecasting because about 25 people have told me it's a book that I really have to read. So we'll go ahead and read that. But anyway, it's just a great approach, putting a little bit of nonfiction into the reading program each and every day. And we're covering lots of stuff I would not have read, and learning a bunch of good stuff and just kind of enjoying it. It's been fun. So now, baseball. I try to come into every February with a little bit of optimism about the Baltimore Orioles. I am having a really hard time doing it. We've made no meaningful roster changes. Our pitching staff, we have two pitchers. Unless some of the young guys step up, the young guys down in the minor leagues I'm talking about, and move up a lot faster than anybody had any reason to hope, the Orioles are in a lot of trouble. Still, it's going to be a great season. Let's face it, the Yankees are going to be a super club. The Angels look really good. Nobody's going to want to play Houston Astros because they now have the best pitching staff in baseball in a very long time. Add that to the offense that was already great. So they're going to look good. The Brewers, they added Yelich. They added Lorenzo Cain. That's going to be a really good baseball team. And the National League Central is no longer going to be just the Cubs and the Cardinals. The Brewers are going to have something to say this year. They're going to really put the pressure on those two ball clubs to play very high-level ball. So it's going to be a great baseball season. pitcher and catchers report here in about 15 days, 16 days, something like that. So we're looking forward to getting back into baseball season. The long winter of my discontent is coming to a close, and spring training will start down here in Florida very shortly. Not a lot of hope from our Orioles, but hey, baseball is baseball. I think it's going to be a fantastic season with a lot to watch. So banking on profits, we're on hold, not doing a lot, not a lot of new stuff to buy. We're looking every day. We're talking to bankers. We're reading statements. We're reading reports. We're looking. Okay. Some stuff that might qualify as a bonus pick on a little bit of a pullback, but I don't see anything really going into the main portfolio beyond the buy list. Now, there were, I think, 12 stocks on the buy list last week. So if you have new money, there's 12 stocks there. I put for subscribers in the blog another 9. I think it was bonus banks that are still, they're small. You got to be patient, use limit orders, but they're still cheap enough to buy. So that gives you a mix of right around 20 stocks where you can get some money to work, where we expect really big things to happen with those banks in 2018 and beyond. 20 should be enough to get, as invested as you want to be. So other than that, we're going to be patient. We're going to be careful. We have cash in the portfolio. We have a hedge in place. So we're just going to move forward. We'll keep looking. We're going to be cautious. We're going to be careful. But we're looking for another fantastic year in 2018. Subscribers, take note. This is a massive week for earnings in our portfolio. So I'm probably going to break it up rather than try to dump all the earnings commentary and reports into Friday's weekly update. Probably do a midweek update right around on Wednesday or so. So that's all I've got from down here. I would say see you next week, but you know what? I do these videos when the mood strikes. Maybe I'll do one next week. Maybe I won't. But until next time, be good and be profitable.